Hello, everyone, and welcome to our latest Structured Finance and Focus podcast. My name is Rui Pereira, and I'm the Global Head of Structured Finance. And today I'm joined by Eric Rothfeld, who's the Managing Director and our Head of North American CMBS New Issue Ratings. On this episode, we're going to be discussing data center securitizations and how we're approaching this growing sector analytically and some of the trends that we're observing. So let's get started. So Eric, where are we with the digital infrastructure discussion paper published earlier this year? And what are some of the key criteria changes being contemplated?
Thank you, Rui. The discussion paper was our first step in our review of the data center sector following our publication of the digital infrastructure criteria in 2021. Our data center methodology really predated the AI revolution and the corresponding increase in demand for power for some of the highest credit companies in the world, combined with large barriers to entry that were created in Tier 1 markets because of the lag or inability to access power. Our goal was to propose a more formal framework to evaluate the qualitative factors that go into determining cash flow and value for data centers and make it uniform across all jurisdictions. The position that we've taken is to have a uniform structured finance approach that covers both CMBS and the ABS markets. We've developed a house view in how to tier various data centers. This includes tracking actual performance to determine sustainable cash flow assumptions, including CapEx and cap rates. On the CMBS side, our review didn't really warrant any material changes for SASB transactions. In fact, we've rated 3 transactions already over the last 6 months. For transactions with ARD structures, that's more common in the ABS side, we're still leading with the same CRE analysis and expertise that we use for CMBS, but we also want to adequately acknowledge the value and the amortization of the notes through cash flows, and liquidation of the properties, depending on the liability structure. We expect to release updated data center criteria that will harmonize the analysis across both structures, CMBS and ABS, later this summer.
Excellent. So obviously a lot of great work and effort put forth. I guess another question I had is, were there major topics that were part of your market outreach as part of this process?
Yeah, among the many topics that were mentioned in calls with market participants, there were 2 topics that really repeated across the majority of the calls: useful life of the property and equipment, and residual value. Useful life of a data center was a concept that we had already identified as critical, and it was the first topic in most conversations. It's more relevant for longer-term life of extended ABS transactions, but changes in technology and the age of an asset can have a material impact down the road. We've already seen a large market reaction to headlines such as the DeepSeek, and we believe that it's important for operators to be able to adapt to change. Ultimately, we concluded that through proper design or future-proofing, plus sufficient CapEx spending, the life of a data center can be extended, and we can avoid a tear-down scenario. Operators we spoke to have described modular considerations such as oversizing the building footprint and plumbing, and flexibility to alter cooling and change rack density to allow for continued upgrades. Obviously, shorter-term equipment like cabinets and batteries will need to be replaced on an ongoing basis, but longer-term equipment like generators, through proper maintenance and CapEx, can have a life that can be extended well beyond a typical 25-year useful life. The most expensive equipment is really the servers, but that remains the responsibility of the tenants. On residual value, we acknowledge the market acceptance and residual value of a data center has become an important component as we harmonize the analysis across both sectors under a commercial real estate approach. We do contemplate liquidation, with the ABS structures also benefiting from amortization. So for the optimal benefit for the ABS analysis, it's really critical the servicer has the ability to liquidate the assets prior to legal final maturity in the event that the bonds are unable to pay in full from cash flow.
And can you maybe spend a minute or two just on the key differences between ABS and CMBS structures and execution?
Sure. The primary difference relates to the flexibility in the structures themselves. ABS deals are issued out of a master trust that's subject to eligibility criteria and rating agency confirmation. It allows for upsizing and changes to the collateral pool. The transactions are also structured with an ARD date and a much longer term than CMBS. While the borrower is incentivized to refinance at the ARD because of penalty interest that will accrue, they have the ability to hyperamortize for 25 to 30 years, and the long-term goal is to fully amortize over that period of time. This gives the borrower greater flexibility since failure to refinance doesn't trigger a default and a forced liquidation as it does in CMBS. In CMBS, there's a static pool of properties with a shorter term horizon than ABS. We typically see 5-year loans, at which time the borrower must refinance or face foreclosure and sale to repay the bondholders. Because of the shorter term horizon, there is greater visibility into the lease profile and relevant technology risk. However, because of the lack of flexibility at maturity compared to ABS, the leverage attachments tend to be more conservative.
Excellent. So what's driving volume in one channel versus another? How are borrowers just choosing between the two structures today?
Well, we are seeing significant activity across both segments of the market from the same operators, and we expect that trend to continue and accelerate given the strong capital needs that we're hearing about. We have been told that major data center owners believe they can tap all available sources of capital given the size of the financing needs. The choice between CMBS and ABS, or even project finance, may be a matter of optimal execution at any particular time in the market, depending on which market may be functioning better. There's less of a distinction collateral type, other than the fact that the CMBS market may allow for larger data centers.
And with data center loans being originated globally, is the criteria update that you're contemplating globally fit for purpose?
We think it is. The qualitative factors that go into determining cash flow and value for data centers will be uniform across all jurisdictions. We'll look for the same quality of an asset, a tenant, sponsor, and overall market demand drivers, whether it's located in the US, Europe, or Asia Pacific. However, certain structural features or availability of data may warrant differences in how a transaction is modeled within the different regions. This remains consistent with how Fitch views US CMBS versus EMEA CMBS, utilizing two different criteria reports.
Unfortunately, we're out of time and we're going to have to leave it there. So thank you, Eric, for your insights. Thank you all for listening. For more information on data center securitizations, please visit our website at fitchratings.com.
Thank you, Rui.